Alright, the other information that we are going to look at would be our variances. And when we look at our variances as well as our standards, standard costs, that's what we're kind of looking at. We talked about in class that a standard was something that was on a per unit basis, and that a budget was on a total basis. So when we get ready to look at different variances, we have variances for direct material, we'll have variances for direct labor, you'll also you can have sales variances, and we can also have overhead variances. And we're going to be looking at these cost variances, and that's what you're going to have as far as your test is concerned. Are cost variances. The things that you need to look at when we deal with these cost variances, we will be looking at amounts. If we look at worksheet, the question number 1, that is looking at direct material variances. And so the information that we have is we do have a standard material, our standard quantity, is what we would be looking at here, of 3 pounds per unit. Some of the other information that we have is that we have a standard price, and our standard price here is at $3.50. We will have an actual number of pounds, and so that would be our actual quantity that we would be looking at, and this is going to be at $15.75. Other information that we may have is we may have actual cost of material purchase. So our actual cost, which would be our actual price number, is going to be at $3.40. And other information that we have is that the actual number of units produced is at 500 units. When we're looking at these different amounts, what the first thing that we have to do is that we really need to calculate what our actual standard quantity is, because what you see at the top is it's telling us it's 3 pounds per unit. But if you look at our actual quantity, it's telling us that we have 1,575 pounds. And so you see 3 pounds per unit and a total of 1,575. Those are not things that we really can compare. So what we have to do is we have to come up with a comparable amount. And so what we do is we take the 3 pounds per unit and we multiply it by the number of units that we actually have. And this will give us our total standard for the units that we are producing. So we will be looking at 1,500 pounds as our standard quantity. Now when we look at variances, it's pretty much a three-pronged approach, where this side over here is your actual. Over here is your standard. So when we look at actual cost, what you're going to find is you can do the actual quantity times the actual price. When we look at standard, we look at standard quantity times the standard price. Now when I look at these pieces of the puzzle, what I'm going to find for actual quantity is $15.75. My actual price was at $3.40. My standard quantity I just found to be at 1,500, and my standard price is at $3.50. So when I do the math here, what I'm going to find is 1575 times 340 is going to give me $5,355. When I look at the standard, I'm going to take the 1500 times 350, and I'm going to get 5,250. Now these amounts that you see are actually looking at the total variance. So that's the whole amount that gives me the total variance when I look at actual versus standard. But to look at different control mechanisms, we really need to break it up and see why we have issues and why we have problems. On this side, we look at price variances. On the side over here, we look at, is it a quantity issue or a quantity variance? So when we go from actual to this middle section right here, we're looking at a change in price. So we would have the actual quantity, and we would change that price to look at our standard price. When we go from the middle over to the right-hand side, you see we change quantity. So we would have actual quantity is what we would be looking at right here, and we would be looking at standard quantity here, and then in looking at standard price for both of those items. So that is how you can kind of look at and decide what's going on with that. Now when I look at actual quantity versus standard price, my actual quantity was at $15.75. My standard price is at $3.50. So I take $15.75 times $3.50. What I'm going to end up with here is $5,512.50. When I am looking at this price variance, I am going to be comparing this actual amount with that amount in the middle. So what I would be doing here is I would be taking this $5,512.50, subtract the $5,355 from that. So 5512, 355, I get a difference or a variance of $157.50. Now, in looking at this information, I have to decide, did I spend more money or did I spend, less money? And so in looking at that, what I'm looking at here, and some of the things, I can look at it and say, okay, my actual cost was actually at $5,355, and that's less than $5,512. The other thing I can look at is this price. So if I have $340 here and I have $350 here, I actually spent less than I thought I was going to spend. So when I spend less than I thought I was going to spend, it cost me less money, I actually pay less than what I thought, that is a favorable variance. So that's a good thing. Now when I get ready to look at the quantity variance, I'm going to be comparing the $5,512.50 to the $5,250. And so when I compare these, and I have 5512 minus 5250, and I have 260,250 is actually my difference that I have here. Now the question that I need to really be looking at here is, did I use more or less than I thought I was going to use? So I can compare here, this $15.75 is what I actually used in pounds. I was only supposed to use 1,500, so I actually used more, and so it's going to cost me more money because I've used more money. I've used more material. So when I use more, that is an unfavorable item. And so this variance would actually be an unfavorable variance. And so when I get ready to look at the overall or total variance, I would actually, I could compare these two items. And so in comparing these two items, the way I would compare these two items is I would take the $157.50 that was favorable. I would take the 262.50 that's unfavorable. Now, when we look at this, this is like saying favorable would be a positive number, unfavorable would be a negative number. And so what we're really doing is when we have an item that's favorable and we have an item that's unfavorable, we would have to subtract these numbers. And so when we do subtract these numbers, what we find is that we have a variance or overall total variance of $105. When I'm trying to decide whether it's favorable or unfavorable, I go to the big number, and our big number here is the 262.50, and we see that it is unfavorable, so this one would actually be unfavorable also. And so this is how you would work those different variances when we deal with price variances, and if we deal with quantity variances. This is how you get those numbers. You can do number 2 when we look at the direct labor variances the exact same way, because it works identical. The difference that you will see when you look at these variances for direct labor is that instead of it being called a price variance, we might call it an efficiency. Not efficiency, I'm sorry. Let me go back out. This one would actually could be called a rate variance instead of a price variance. And then this other side, instead of quantity, we're dealing with time, so it's how efficient are we being. So this one could be an efficiency variance. So you might see them called these different things. Again, you're looking at actual cost over here, you're looking at standard here. And so what we're looking at is the, and then in the middle, you would be doing the same thing like we did before. We're looking at a change in rate. So we would be looking at a standard rate here, and we would be looking at actual hours is what you would actually have in the middle column. You would go out, you would do those different rates and find your standards and everything just like we did for direct material. When we look at the other thing that we have here, that is done differently is the overhead variances. And what we see with the overhead variances is that we have amounts that are controllable in nature, and then we have amounts that deal with quantity, and so we really can't do anything with those items. So with this, what you would do is you would look at, you would pretty much have to do a flexible budget for whatever amount you actually did, because you're going to be given a budget. And if you look at number 3, we are given a budget here based on 4,500 units. But what it tells us is that we are actually actual production is not 4,500. It is actually at 5,000 units. So when we look at this, we do have to prepare a flexible budget based on the amount of 5,000 units. Now remember, we've already discussed flexible budgets. So when we do look at the flexible budget amount, when we look at variable overhead, we have to figure out what it is per unit. And so in this particular problem that we see, we have $27,000, but that is based on a budget of only producing 4,500 units. And so that's based on pretty much $6 a unit. So the next step is to take and figure out what would it have been at 5,000. So at 5,000, we would take 5,000 units times 6, and we're actually looking at a cost of $30,000 based on this flexible budget of 5,000 units. Now remember, for fixed, we stay the same. It doesn't change based on our numbers that we're producing, our production levels. So when we get ready to look at our variances for overhead, we're still going to have actual on that left-hand side. We are going to have our standard amount that would be on our right-hand side. Now, standard here, what we look at is the static budget. So the static budget. And so we are looking at total variances here. The middle would be what our flexible budget is. So it's going to actually be looking at that actual cost. So in this particular problem, what I want to do is I want to look at what the variable overhead amounts are as well as the fixed overhead amounts. So we're going to start with variable. Our actual amount for our variable cost is given to us, and they told us it was $26,000. Now our static budget said that we should have been at $27,000. When we did our flexible budget just a few minutes ago, we saw that the flexible budget was saying that we needed $30,000, or that it was going to be the flexible budget there would have been $30,000 as far as that amount was concerned. So in looking at these variances here, this one is the controllable variance. So in looking at the controllable variance, and this one over here is a volume variance. So it's based on what's going on with our different quantity amounts when we look at that volume variance. So here what we will find is, let's see, let me go back here. What we find is that we have a controllable variance, and we're looking at the 30,000 minus the 26,000, and so that's giving us a total of 4,000. In this case, we did spend less money than we thought we were going to spend, and so this would be a favorable variance. The other way to look at favorable or unfavorable, as we go across here, if the number increases, then it's favorable. If the number decreases, it's unfavorable. So the next one I'm looking at is I have 30,000, I have 27,000, and so I'm going to have a variance of 3,000. Here I am decreasing, so this one is unfavorable, and my total variance here would be $1,000, and it would be favorable. And the reason that this is favorable is because this number, the 4,000, is bigger than the 3,000. So we would take that, and that's how we get that favorable amount. The last one that I want to look at is looking at the fixed overhead amount. And when I look at this fixed overhead amount, what I'm going to be looking at are the same things. I'm still going to be looking at the static budget here. I'm going to be looking at the actual amount here, and I'm looking at the flexible budget. So when I look at these different amounts, I have an actual cost of $35,000. My flexible budget, which is going to be the same as my static budget for fixed cost, is at $33,750. So both of these numbers, when I deal with fixed overhead, these are going to be the same. So that volume variance will always be 0, okay? Always 0 when I'm dealing with fixed overhead, okay? So that's always 0. But I do have to look at the amounts here. So I have 35 minus 33,750. And so when I'm looking at these, I have a difference of 1250. And when I look at it, again, as I go this direction, if it increases, then it's favorable. If it decreases, it's unfavorable. And you see, I have decreased, so this would be unfavorable. And my total variance here, because I am looking at zero on one side and the 1250 on the other side. So my total variance would just be what the controllable variance was. And so remember, this one is the controllable amount, the controllable variance. And that would be how you would actually do overhead variances. Keep in mind, direct material variances and direct labor variances are done the same way. Overhead variances, you do have to figure out what your flexible budget is for overhead variances. So hopefully this will help you get ready as far as the test is concerned, and you'll be able to understand everything that you've got to do.